early 2026, the global financial landscape is defined by multidimensional polarization. While equity markets in the US, Europe, and Japan are buoyed by an AI-driven earnings supercycle, systemic shifts in currency, debt, and regulation are fundamentally altering the plumbing of global finance. 2026 Financial Forecast and Global Implications. 1. The cross-currency basis. What is the cross-currency basis? Cross-currency basis, the premium paid to swap foreign currency for US dollars, reflecting global dollar scarcity and systemic banking liquidity stress. The cross-currency basis serves as the price of dollar scarcity. In 2026, as the U.S. Federal Reserve concludes its easing cycle, the basis has widened, particularly for the Australian dollar and Japanese yen. For global stock markets, a persistent negative basis in Japan increases the cost for local investors to hedge U.S. equity holdings, potentially slowing the flow of Japanese capital into the S&P 500. Conversely, Australian super funds are exploiting positive spreads to enhance yields. This divergence signals a fragmented liquidity environment where the cost of accessing USD remains a premium for international expansion. 2. Euro-gold arbitrage. What is the Euro-gold arbitrage? Euro-gold arbitrage, exploiting price differences between euro-denominated gold and USD spot prices, often used as a hedge against euro currency devaluation. With gold breaking past $4,500 per ounce in early 2026, a unique arbitrage has emerged between euro-denominated gold and USD-denominated spot prices. European investors are using gold as an alternative fiat to hedge against a fluctuating euro, which faces pressure from uneven European Central Bank (ECB) policies. This arbitrage creates a feedback loop. As the euro weakens against a sticky USD, the local price of gold in Europe spikes, driving retail and institutional liquidations of euro-based assets into physical gold. This migration of capital exerts a drain effect on European mid-cap stocks as investors prioritize wealth preservation over growth. 3b. Beware of euro banks. The warning for euro banks in 2026 centers on late-cycle headwinds. While Tier 1 capital ratios appear solid. What are Tier 1 capital ratios? Tier 1 capital ratios measure a bank's financial strength by comparing its core equity capital to its total risk-weighted assets. It indicates the bank's ability to absorb losses. Example: if a bank has $10 billion in equity and $100 billion in risk-weighted assets, its ratio is 10%. This suggests it is well capitalized and stable. The risk lies in synthetic risk transfers, SRTs, and opaque linkages to private credit. As the property sector continues its sluggish recovery, banks are offloading risk to non-bank financial institutions. For the stock market, this creates a hidden leverage trap. Any significant default in private credit could trigger a contagion back to the banking majors. Investors should be cautious of French and German lenders, whose net interest margins are peaking just as credit losses begin a moderate uptick. 4. The Euro sovereign bond market. What is the Euro sovereign bond market? Euro sovereign bond market, the marketplace for debt issued by Eurozone nations, serving as the benchmark for European interest rates and fiscal health. The Euro sovereign bond market is undergoing a structural shift toward higher long-term yields. While short-term rates remain anchored by the European Central Bank, ECB, long-term bond. What is the long-term bond? German bonds are long-term federal bonds considered the Eurozone's safe haven benchmark. Their yields reflect Europe's lowest risk borrowing costs. And BTP yields. What are the BTP yields? Italian BTPs are long-term sovereign bonds. Their yields are higher than bonds, reflecting a risk premium for at least higher debt. They are grinding higher due to massive issuance needs. This steepening of the yield curve is a direct result of increased fiscal spending and the transition of the Dutch pension system away from long-dated debt. For global markets, higher European risk-free rates are tightening financial conditions, acting as a gravitational pull that limits the valuation multiples of Eurozone equities compared to their U.S. peers. 5. Joint Corona bonds and defense bonds. What are the joint Corona bonds and defense bonds? Joint Corona and defense bonds, EU-issued collective debt instruments designed to fund pandemic recovery and, more recently, unified continental military and cyber infrastructure. The evolution of Corona bonds into joint defense bonds is the fiscal story of 2026. A coalition of the willing is issuing roughly €2 trillion in collective debt to fund AI, cyber defense, and satellite infrastructure. This creates a large, liquid, and secure euro-safe asset that competes directly with U.S. treasuries. For the markets, this is a double-edged sword. It provides a massive stimulus to the European aerospace and defense sectors, supporting stock prices, but the sheer volume of new supply could crowd out corporate bond issuance, raising borrowing costs for non-defense companies. 6. The Basel III Endgame Capital Rules. What are the Basel III Endgame Capital Rules? Basel III Endgame finalize global regulatory standards requiring banks to maintain higher capital buffers to survive market volatility and credit losses. After years of debate, the Basel III Endgame is arriving in 2026 with a capital-neutral compromise. While initial proposals threaten to hammer bank valuations, the final rules are more industry-friendly, focusing on harmonizing risk-weighted assets, RWAs, without forcing massive new capital raises. This is a green light for U.S. and European bank stocks, as it allows for increased share buybacks and dividends. However, the 70% output floor implementation means that banks using internal models must hold more capital than before, slightly curbing their ability to fund aggressive market making in the derivatives space. 7. The engine of global gold buying. Why buy gold? Why buy gold? To hedge against inflation, diversify away from fiat currency debasement, and protect wealth during periods of intense geopolitical instability. The engine behind gold's relentless rise to $5,000 per ounce is no longer just fear. It is a structural shift by emerging market central banks, led by the BRICS Plus, and a new wave of ETF inflows. Central banks are now averaging 750 plus tons of annual purchases to diversify away from the USD. In South Korea and Brazil, public mandates to increase gold reserves to 20% of total assets have turned these institutions into price-insensitive buyers. This consistent demand provides a hard floor for gold, making it a permanent pillar of the 2026 multi-asset portfolio. 8. The Golden Reservoir, the AI Supercycle. What is the AI Supercycle? The AI Supercycle, a prolonged period of massive investment and productivity gains driven by the rapid, global integration of artificial intelligence technologies. The AI Supercycle has created a golden reservoir of earnings. In 2026, AI investment accounts for nearly 2% of global GDP. This isn't just a tech story, it's a productivity story affecting US, Korean, and Australian markets. AI is driving a 13 to 15% earnings growth in the S&P 500, making tech the primary reservoir of global liquidity. However, the energy demands of AI are sparking a secondary commodity supercycle, where copper and silver are surging alongside gold, linking the digital revolution to physical resource scarcity in a way not seen since the industrial era. 9. The BRICS Countries Alliance. What is the BRICS Countries Alliance? BRICS Alliance, a geopolitical bloc, Brazil, Russia, India, China, South Africa Plus, seeking to reduce Western economic dominance and dollar dependency. The BRICS Plus alliance has moved from rhetoric to reality with the 2026 launch of the unit, a gold-backed digital currency system for cross-border trade. With Saudi Arabia and the UAE now fully integrated, 46% of the global population is part of a trade bloc that bypasses the traditional SWIFT system. This de-dollarization is creating a bifurcated global stock market. While Western markets remain dominant, a South-South trade corridor is booming, leading to outsized performance in Latin American and Southeast Asian equities that are now decoupled from U.S. interest rate cycles. 10. Global implications of energy sovereignty. What is energy sovereignty? In 2026, energy sovereignty is the primary driver of market divergence. In the US and Australia, self-sufficiency in gas and renewables bolsters industrial stocks and data center rights. Conversely, Europe and Japan face sovereignty premiums, where high input costs drag on manufacturing margins, though UK wind initiatives offer a silver lining. South Korea is pivoting heavily toward nuclear to protect its semiconductor exports. In South America, nations like Brazil are emerging as energy exporters of choice, attracting massive foreign direct investment, FDI. Globally, stocks in companies with behind-the-meter power solutions are outperforming as nations race to decouple from volatile global grids. Closing statement, the 2026 synthesis. The overarching theme of 2026 is resilience amidst fragmentation. The global economy is absorbing the shocks of high debt and geopolitical shifts because the AI supercycle is providing a genuine boost to corporate productivity. However, the vital missing link is energy sovereignty. As the US, Europe, and Japan compete for the electricity required to power AI data centers, the green-to-gray energy transition, shifting from fossil fuels, gray, to renewable sources, green, like solar and wind to reduce carbon emissions and combat warming. This energy transition is becoming the ultimate arbiter of market winners. Investors must balance the golden reservoir of tech growth against the systemic risks of a splintering currency world. Help us to bring you the best content possible. Subscribe, share, like, and comment.
This is the stock market performance.